we're going to take a look at the partnership video today. And so in looking at the partnership video, some things that we just would like to review are items such as partnerships will use capital, they will use distributions, or those drawing accounts, and just to kind of go back in and review some of those items from your Principles 1 class. Some of the things that we will come into play will be items such as capital contributions. We'll be looking at those items. Other items that we look at are the, of course, distributions or the drawings by an owner. And then some of the underlying things are those closing entries. So when we look at closing entries, that was chapter 4 in your, generally it's about a chapter 4 or 5 in your principles class. You know, these two items generally close to the income summary and kind of give us that net income. And then our income summary and our drawing accounts are going to close to the capital account. So what we've seen in the past is if we want to close income summary, which is that I, and we have a net income, then we would debit income summary and we would credit the capital account, is what you would see. All right, and so that's what we have for those different items. Now, if we had an item where we had a net loss, it would pretty much just be the opposite, because our capital account would be decreasing if we have a loss, and we just really are trying to close out what we have for that income summary. So that would be those I's. Both of those. Just depends on if you have net income or a net loss. The other thing I want to look at is the D. So when we look at this D, that is the drawing account. And if you remember back to Principles 1, what we had to do was close that to our capital account. And so to make that happen, we would debit our capital account and we would credit the drawing account to make that balance out the way that we need it to. And so that's when we just have one capital account, one drawing account. It's very, very similar when we have two or more of those accounts. And remember, for partnerships, every partner will have a separate capital account and every partner will have a separate drawing account as well. So it just kind of expands on the things that you did in principles as far as those closing entries. And so I just wanted to kind of remind you of some of that. When you are looking at what a partner's balance is in an account, that kind of can go back to that statement of owner's equity that we have done in the past. And so with that, we start with our beginning capital balance. We then would add to that any capital contributions or owner investments would be added. Our net income would be added. And so we would add those items together, come over here and get a subtotal. And then we would subtract out a couple of items, and those things that we would be looking at subtracting out are going to be the drawing account. And if you had a net loss, it would go in here. So we, finish that out, subtract that, and what that gives us is our ending capital balance. So those are the things that you really need to just be mindful of whenever we are looking at these different accounts, just as a refresher in closing entries and in how we figure out what the ending balance is in a capital account. So now I want to go forward and start looking at this partnership worksheet. So with the partnership worksheet, what we start off with is we have two people, Kaylee and Simone, who have decided that they would like to start a partnership. Simone is going to be contributing cash, but she's also going to be contributing equipment, and that equipment does have a loan associated with it. Kaylee's is pretty straightforward in that she is just contributing cash to it. So let's go ahead and just do Kaylee's first, since hers is more simple than what Simone's is. And so with Kaylee contributing cash, what this means is that we are getting cash in the amount of $20,000. Why do we get that cash in? Why is our cash balance going up, which means it would be on top? Is because Kaylee actually contributed money to the business. And so that would be her capital contribution. Looks very, very similar to what we saw in your Principles 1 class when a single owner in a sole proprietorship would put money into their business. Now for Simone's, it's a little bit more difficult because with hers we kind of have to look and see what all is going on. So for Simone, what we have is she has cash that's coming in, and that cash is $10,000. But then she also has equipment. Now that equipment has a loan value attached to it. And that loan value is going to go into this partnership. So we are going to have to do that net of that loan value to figure out what her contribution is going to be, because her contribution is going to be what she has, but we have to net out any loans that the partnership is taking over. The other thing that I need you to understand is when you contribute property to a partnership that you have previously owned, you will not use your basis in that property. You are going to use whatever the fair market value is of that asset. So if you are putting assets into the corporation, or not corporation, sorry, into the partnership, then you would just kind of put that there. So when we look at Simone's entry, and I am doing two different entries here just to kind of keep it a little bit neater. So we would have cash of $10,000. The other thing that we have is equipment is being contributed, and so that equipment is valued at fair market value, which is $20,000. We also have a loan, so that is going to be a note payable amount, and so when we see that note payable, that is $5,000, and then what we have left over is going to be her capital account. So the capital account for Simone is in fact going to be $25,000. And so now we have looked at both the contribution from Kaylee and the contribution from Simone at starting this in the formation of this particular partnership. The next entry we're going to look at, which is number 2, looks at distributions from the company or from this partnership, and those distributions are what we call withdrawals, or the drawing account. And so Kaylee and Simone both are taking money out of the company for this year, and so we need to prepare the necessary journal entries for when this happened. Now you can do these as 2 separate entries, or you can do it as 1 entry. I'm choosing to do it as just as 1 entry. And so what I'm going to have here is I'm going to be looking at those drawing accounts. And so Kaylee is going to be withdrawing $500 from the company. Simone is going to be withdrawing $800 from the company. And so that is a total cash outlay of $1,300. So what we would have is we'd be increasing that drawing account for Kaylee and for Simone because they took money out of the company, and notice they both have an account that is separate, associated with their name, and then the total cash outgo is $1,300. So that's how you would do a distribution. And again, it could be 2 entries or 1. You could do one for Kaylee and one for Simone, or you could do them both together. The next item on the kind of agenda is at the end of that time period when we have to close out what our income is to our capital accounts. And the way we look at doing this is going to depend upon what our partnership agreement states. So our partnership agreement could say that we're going to split it just on a stated percentage, which is what we look at in on number 3. It also could be based on whatever your balance is in your capital accounts. It also could be placed on if you had any services that you were providing. It could be very complicated to figure out. We are going to look at 2. We're going to look at if it was a stated percentage. We're also going to look at if we had an allocation based on the capital balance. So number 3 is the one that we're kind of going to stick with when we're looking at other items in the problem. This is just a what if item for number 4. So I just wanted to kind of put that out there. So what we look at with this deal is that their profits are going to be split. And so with Kaylee, of that $10,000 profit, 45% of that belongs to her, which is going to equate to $4,500. When we look at Simone, of that $10,000, 55% belongs to her, and so that is going to be $5,500 that would be associated with Simone's account. So in doing that and looking at it, what we see is that we do have to make that journal entry to close out the income summary account into their capital accounts. So we're just moving that profit over, and the way that is done, because this is a profit amount, we would debit income summary for that full amount. So for that full $10,000. We would then come in and we would put these amounts towards their capital accounts. So we have amounts going to Kaylee. We also will have amounts going to Simone. And the amount that Kaylee has going into her capital account for this profit is 45. Simone's is 55. So that is if we had a straight split that was put into our partnership agreement. Now this next one is a what if. So it's not an additional $10,000 or anything else like that. It's a what if the agreement was split based on allocation of the capital instead of a static amount. And so what we would have to do is we would have to figure out how much do they have in their capital accounts. And so when we look at their capital accounts, we'll come over here, and if we look at Simone's capital account, what we find is that, initially she had $25,000, and then we had that withdrawal of $800. Now I don't have all of these journal entries out here because I don't have that D or drawing journal entry, but if I had that journal entry, then this is really what it would look like. And if we went back to look at figuring those balances, what we would see here is that we would look at what did they contribute, did they take any money out to get to that ending balance. And so this balance right now is going to be at $24,200 for Simone's. Now, when we look at Kaylee's account, she started with $20,000 in her account, and that was gotten from right here, and then we had a drawing of $500, and so her account now has $19,500 in it. So I need to now figure out what their different percentages would be. And so in looking at this, I have Simone that has the $24,200 in her capital account. I have Kaylee that has a balance of $19,500. Now, under this allocation based on capital balances, we have to figure out what the total amount is. And so the total amount here is $43,700. We would then take their capital balances, we would divide it by the total amount, which is the $43,700, and in Simone's case, we would end up with 55.4%. When we look at Kaylee's, we would divide hers by that total amount as well, and of the total, she will have 44.6% of the total. So if we want to know how much of this $10,000 profit belongs to each of them, we would just take their percentage, multiply that by that $10,000, and we would get $5,540 for Simone. When we do the same thing for Kaylee, we would end up with $4,460. So these would be the amounts that would be allocated towards their capital accounts with the journal entry. Now remember, this is the what if. This is not, what we're continuing with. This is just a what if. So with that, we would have that income summary. That wouldn't change in this what if scenario because we still have that $10,000 profit. But what would change is the actual dollar amount of what's going to Kaylee and what is going to Simone, because it's based on a different percentage. So Kaylee would have the $4,460 now instead of $4,500. Simone is going to have $5,540 instead of the $5,500 because their percentages are a little bit different based on what their capital balance was, and it's their percentage of the total capital that is out there. And so that's kind of what we look at as far as that goes. So those are just two of the different ways. There is another way that we can do this, but those are your two big ways there. The other thing we look at, and I want to still be able to see Kaylee's capital balance, if Kaylee decides to sell her interest in the partnership to Dylan for $35,000, what would happen on the partnership's books? What would the journal entry be? Well, I can tell you that this information, as far as that $35,000, is not going to be relevant. And the reason it's not relevant is that is a personal transaction and it has nothing to do with the partnership. So that $35,000, nothing's going to happen with that. Now, what we do need to figure out with all of this information is what is Kaylee's balance in the partnership? And the reason that we need to know Kaylee's capital balance is because she's no longer a partner. So her capital balance needs to zero out. And that then would need to move to Dylan, and it would be his capital balance. And so what we do is we come in and we look and we see that, Kaylee contributed $20,000. She took out $500. We've made some money, and we've made $4,500. And so we would take that amount that was added to her capital account, and what we would find is that Kaylee is sitting here at that $24,000 mark. And so that $24,000 mark that we see right here, that is going to be the amount that is going to transfer, as far as the books are concerned, from Kaylee's account to Dylan's account, because we need to zero out her account. And the only way we can zero out her account is if we come in here and we put that debit in. So what we see is we have Kaylee's capital account is going to decrease by that $24,000, and then Dylan's account would increase because he is now an owner in the company. And so that is what we see with what is happening with this particular transaction. And this is when one partner decides to sell an interest to someone outside of that partnership. This is what you would see, is those capital accounts would need to switch out and would need to change when that happens. All right. The other thing I want to note is that when partnership changes, whether it's somebody leaving the partnership or somebody coming into the partnership, we do have to do a new partnership agreement because the partnership has in effect dissolved, and so we would have to do that. All right. The next thing that we can look at here is where we have Simone and Dylan decide to let Christian join the partnership. And so when Christian joins this partnership, it's really just a contribution for Christian to join it. And so what happens is Christian's going to be putting cash into this company in the amount of $10,000. And so his capital account is going to increase by that $10,000. And so that's all that really happens. If somebody new joins that, they're just contributing just like what would have happened if they had joined at the beginning. But note, new partnership agreement now because we have a new partner. So we do have that new partnership. The next thing that we are going to look at is what happens if the partnership is liquidated. So if the partnership is being liquidated, then we do have a couple of steps that we have to do. Now, our information for this particular problem is that there is a profit and loss agreement in their partnership that Simone's a 50% partner and gets 50% of the profits or losses. Dylan gets 30% of profit and losses, and Christian gets 20% of the profit and losses. We also have a factoid that our equipment can be sold for $2,500, and it wants us to prepare the necessary journal entry. This below is a trial balance of what the partnership has at this time of liquidation. And so what we do when we look at liquidation is we have a couple of steps. So under step 1, we need to sell all of the non-cash assets. So the non-cash asset that I see is equipment, and equipment has an account called accumulated depreciation with it that also needs to be closed out. So if you think back to your depreciation chapter in your first principles class, what you're going to go back to is that one of the first steps in selling something is figuring out and establishing what the book value is for that particular piece of equipment. So here we have this equipment, and this piece of equipment is valued at $30,000 on our books. We have accumulated depreciation, which needs to be subtracted from our value of equipment, And this is going to leave us with a book value of $20,000. But that's not the only thing we have to look at. We also have to look at the fact that we are going to be getting cash of $25,000 in. We have a book value of $20,000, which gives us a $5,000 gain. So when I do this particular journal entry, what I have here is I'm going to have cash coming in at $25,000. I'm going to be getting rid of that accumulated depreciation. It needs to go to 0, and the only way to do that is to debit it. I am going to be getting rid of the equipment, so that needs to go to 0, so that needs to be a $30,000 credit. And then when I'm all done, I have $30,000 on this side, I have $35,000 here, and I need to make sure my transaction balances, and that is going to be a gain on liquidation. And that gain on liquidation would be $5,000 is what we would see. Now we're not done, because that $5,000 is a profit, and so we need to take that and put that into our partnership's profit and loss agreement and figure out what the capital balances would be for our 3 partners. So in doing that, what we would have to do is, for instance, with Simone, we take that $5,000 gain. She has a 50% stake in that, which means her capital account needs to be an additional $2,500. When we look at Dylan's, we take that $5,000. He has a profit gain of 30%, and so that's going to be $1,500. And if we take Christian's, we take the gain of $5,000, multiply it by his profit percentage, which is 20%, and that's $1,000. So now we know the amounts that we will need to use for this journal entry to finish this out and do this journal entry. So we need to get rid of this gain on liquidation. So the second part of this step is to kind of get rid of that. So we would have the gain on liquidation for that $5,000. We would have a capital addition to capital for Simone for $2,500. We would have an addition to capital for Kaylee in the amount of $1,500. And we would have an additional capital amount to Christian for $1,000. And so that closes that profit, that gain, back out to their capital accounts. So that's step 1. Step 2 looks at, we have to make sure all of our debt's paid. So we need to pay all of our liabilities. We only have 2 liabilities here. We have accounts payable and we have notes payable, and these items are going to be paid, right? And so that means a decrease in cash, which means cash is going to be on the bottom. It's going to be our credit account, and that means that our accounts payable and notes payable are going to be our debit accounts. So I have accounts payable, and that's $5,000. I have a note payable still due, and that's $1,000, which means I'm going to be paying out cash in the amount of $6,000. That is going to be your step 2. Then we get to step 3. Step 3 looks at distributing that cash based on what's in our capital accounts. So at this point, we would need to know what our capital balances were and what our cash balance and all that is, because we've already zeroed out all the other accounts. We zeroed out equipment, accumulated depreciation, accounts payable, and notes payable. Those are all zero. That gain on liquidation is all zero. So all we have now is cash and the capital accounts. Now, I don't have it in this example, but let's say that one of our partners had a negative balance in their capital account at this moment in time. If that were to happen, what we would see is that that particular owner would have to pay the partnership back that negative balance, and then it would be distributed out to the other partners based on, you know, what their accounts actually showed. So right now, let's look at our capital accounts and our cash accounts. So for cash, if I look at the T account, we started with $50,000. We received $25,000 from the sale of the assets. We paid all our liabilities, which was $6,000. And so what that does is that gives us a balance of $69,000 in our cash account to be distributed to all of the different owners. Now, who's going to get what? Well, we need to look at their capital accounts to figure that out. So we take Simone's capital account. Simone's capital account is $30,000 according to the trial balance. That's what we're starting with. She has had $2,500 added to her account, and so her balance is now $32,500. When we look at Dylan's account, Dylan started with $23,500. Dylan had, I had the wrong name there. Dylan had $1,500 added. And so Dylan would be at $25,000. And then we need to look at the capital account for Christian. He started at $10,500. He had another $1,000 added. So that means he is at $11,500. So I'm now able to make my journal entry because I need to close all these accounts out. And the way I'm going to close those accounts out is my capital for Simone would be a debit of $32,500. My capital when it comes to Dylan is going to be $25,000. The capital for Christian is going to be $11,500, and that's going to give me a cash value coming out of $69,000. So at this moment, I will have closed out cash, closed out the capital for Simone, closed out Dylan's capital, closed out Christian's capital. If I add all these up, that does equal $69,000, and I am all done with the dissolution of this partnership. So there are other entries in your textbook that you can take a look at, and those entries look at bonuses and items like that when a partner joins a partnership, or if a partner leaves that partnership, what happens when, partner dies, how we deal with that. All of that is going to be found in your textbook, and you can take a look at that.